Welcome back to Smart Dollar Mindset, the channel dedicated to helping you achieve financial freedom through smart money habits and investing. Today, we're tackling one of the most important yet often overlooked financial questions. Where should you keep your emergency fund in 2025? An emergency fund is the financial cushion that keeps you afloat when life throws unexpected challenges your way. It's your shield against job loss, medical bills, car repairs, or any surprise expense that could otherwise derail your financial plan. But here's the big question. Once you've saved that emergency money, where do you actually put it? Should you keep it in a regular savings account? Should you chase higher interest in a money market account? Or should you consider newer options like online high-yield accounts, cash management accounts, or even short-term Treasury bills? In this video, we're going to break it all down, step by step. I'll walk you through the different places you can keep your emergency fund, explain the pros and cons of each, and help you decide which option makes the most sense for your situation in 2025. Stick around until the very end, because I'll also share a powerful framework for balancing safety, accessibility, and growth. 3 things that every emergency fund must account for. Let's start with the basics. What exactly is an emergency fund? At its core, an emergency fund is money set aside specifically for unplanned expenses. Think of it as your financial safety net. The recommended amount typically ranges from 3 to 6 months' worth of essential living expenses, but the right number for you depends on factors like job stability, family responsibilities, and risk tolerance. For instance, if you're single, have a stable job, and no dependents, 3 months of expenses might be sufficient. But if you have a family, own a home, or work in an industry where layoffs are common, 6 months or even more might make sense. The key isn't just having the money, but keeping it in the right place where it's safe, liquid, and accessible. The first option most people think of is a traditional savings account. It's simple, familiar, and offers immediate access to your funds. But in 2025, traditional savings accounts at big brick-and-mortar banks still pay shockingly low interest rates, sometimes as low as 0.01%. That means if you had $10,000 saved, you'd earn just a single dollar in interest for the entire year. Clearly, this isn't where you want to keep the bulk of your emergency fund if you care about growth. However, traditional savings accounts do have one advantage: accessibility. If you need cash instantly, your money is right there, linked to your checking account. For some people, that convenience outweighs the low returns. That brings us to a better option: high-yield online savings accounts. In 2025, online banks are offering competitive interest rates, often between 4% and 5%. That same $10,000 sitting in an online savings account could earn you $400 to $500 a year, without any extra effort. And since these accounts are FDIC insured, your money is safe up to $250,000 per depositor per bank. The trade-off is that transfers from online banks may take a day or two to hit your checking account. But for most emergencies, a 24 to 48-hour delay is perfectly manageable. And for the peace of mind of having your money grow faster, the slight inconvenience is often worth it. Take the example of Sarah, who kept her $15,000 emergency fund in a high-yield online savings account. Over 3 years, she earned nearly $2,000 in interest, money that went straight back into her safety net, essentially paying her for being prepared. Compare that to her friend Jason, who kept his fund at a traditional bank earning next to nothing. After the same 3 years, Jason had barely earned enough to buy lunch. The difference is clear. Where you keep your emergency fund matters. Another option worth considering in 2025 is a money market account. These accounts often offer interest rates comparable to high-yield savings, but with added perks like limited check writing privileges or even debit card access. This makes them slightly more flexible in true emergencies, since you can pay directly without waiting for a transfer. The downside is that some money market accounts require higher minimum balances, sometimes $2,500 or more. If you're just starting your emergency fund, that could be a barrier. But if you already have a sizable cushion, a money market account can strike a great balance between growth and accessibility. Now let's talk about certificates of deposit, or CDs. At first glance, CDs might look appealing, especially if you see promotional rates north of 5%. But CDs lock up your money for a set period, anywhere from a few months to several years. And while there are penalty-free CDs that allow limited withdrawals, most will charge you for accessing your money early. That makes them risky for emergency funds. After all, the whole point of an emergency fund is that it should be available whenever you need it. That said, some people do use a CD ladder strategy for a portion of their emergency fund, splitting the money across multiple CDs with staggered maturity dates. This can maximize interest while still providing access every few months. But for most people, CDs aren't the best home for an emergency fund in 2025. Here's a newer option many savers are exploring: short-term Treasury bills. With interest rates higher than they've been in years, 3-month or 6-month T-bills can be a safe and effective place to park cash. They're backed by the U.S. government, so there's virtually no risk of default. And in some cases, they can out-earn even the best high-yield savings accounts. The trade-off is accessibility. If your money is tied up in a Treasury bill, you can't use it until it matures. You can sell early, but that may involve extra steps or even a small loss. For that reason, Treasury bills are best for people who want to maximize returns on a portion of their emergency fund, but still keep a core amount in a liquid account for true emergencies. Cash management accounts are another modern option in 2025. These are offered by fintech companies and brokerages, and they combine features of checking and savings accounts. They often come with high yields, no fees, and convenient access through debit cards and transfers. For example, imagine keeping half your emergency fund in a high-yield online savings account and half in a cash management account. The savings portion grows steadily, while the cash management side gives you immediate liquidity if an emergency strikes. This dual strategy ensures both growth and accessibility. Of course, one option that often comes up is investing your emergency fund in the stock market. And let me be clear, this is a mistake. Stocks are too volatile for money that must be safe and available at all times. The last thing you want is for an emergency to hit right after the market drops 20%. Your emergency fund is not the place for risk. It's the foundation of your financial security. So how do you decide where to keep your emergency fund in 2025? The answer lies in balancing 3 key factors: safety, liquidity, and return. Your money must be safe from loss, easily accessible when you need it, and ideally earning some interest while it sits. The strategy I recommend is a layered approach. Keep a small portion, say 1 month of expenses, in your regular checking or savings account for instant access. Place the bulk, 3 to 5 months of expenses, in a high-yield online savings account or money market account where it earns a competitive return. And if you want to optimize further, consider putting 1 month's worth into short-term Treasury bills or a CD ladder for slightly higher returns. This way, you're never without cash in an emergency, but your money is still working for you in the background. Let's walk through a real-life example. Imagine Maria, who has $24,000 set aside as her emergency fund, 6 months of her expenses. She keeps $4,000 in her checking account for instant access, $16,000 in a high-yield online savings account earning 4.5%, and $4,000 in 3-month Treasury bills. This setup gives her $4,000 she can use immediately, $16,000 that's accessible within 48 hours, and $4,000 that's growing slightly faster but still safe. This layered approach is flexible, resilient, and effective. It ensures Mariah is never caught off guard while also ensuring her money isn't sitting idle. Now let's address a common objection. What if you're just starting out and don't have thousands saved yet? The principle is the same. Even if you only have $500 or $1,000, you still want it in a safe, accessible place. A high-yield online savings account is usually the best starting point. The key is to start building consistently, even if it's just $50 or $100 a month. Over time, those small contributions grow into the cushion you need. One powerful transition here is to think of your emergency fund not just as a static pile of cash, but as a dynamic part of your financial plan. It's not money that's being wasted by sitting idle. It's money that's buying you peace of mind. That peace of mind allows you to invest more aggressively with the rest of your portfolio, knowing you're protected if life throws you a curveball. Imagine driving without car insurance. Every bump in the road would make you anxious. That's how it feels to live without an emergency fund. But with a solid emergency fund in the right place, you can drive forward in life with confidence, knowing you're covered no matter what. Final thoughts. So where should you keep your emergency fund in 2025? The short answer is somewhere safe, liquid, and ideally earning interest. High-yield online savings accounts and money market accounts are the top choices for most people. Treasury bills and CD ladders can play a supporting role for those who want to optimize returns. And for instant access, keeping a small amount in your checking account makes sense. But here's the bigger takeaway. The exact account you choose matters less than the discipline of actually building and maintaining your emergency fund. Too many people get caught up chasing the highest yield and forget that the primary goal is safety and accessibility. If your money is there when you need it, it's serving its purpose. The real power of an emergency fund isn't in the dollars it holds, but in the freedom it creates. It frees you from the stress of living paycheck to paycheck. It frees you to take risks in your career, knowing you have a safety net. It frees you to invest confidently for the long term without worrying about short-term setbacks. And perhaps most importantly, it frees you from fear. Fear of what might happen if your car breaks down, if your job disappears, or if life throws you an unexpected curveball. With an emergency fund, those fears don't control you, you control them. So as you decide where to keep your emergency fund in 2025, remember this. The smartest financial move you can make isn't just about chasing returns. It's about building stability, security, and peace of mind. Once you have that foundation in place, you can focus on building wealth, achieving freedom, and living life on your own terms. Thank you for watching Smart Dollar Mindset. If you found this video helpful, don't forget to subscribe, hit the like button, and share it with someone who needs to hear this. This channel is dedicated to helping you create financial freedom with smart money habits and investing, and I can't wait to share more insights with you in the next video.